Good morning and welcome to PHDwin Week. I'm glad you're here, especially because it's the last day and it's a presentation about eating frogs, which expect very many people to sign up for that. Just right at a year ago, I was at a conference, a small gathering, and I heard a Q&A interview session one-on-one with the CEO of ConocoPhillips. And he observed that there are three major problems facing the industry. None of them were the energy transition or the potential decline in global oil demand. Number one, he said, was the issue of our emissions. Now, and number two, he said, was our issues of decommissioning, not being prepared for decommissioning. And number three was very important, so important I don't remember what it was. But emissions and decommissioning certainly are two of the biggest issues we face. Now, in the space of emissions, we still do have a problem. We hear lots of reports about the improvements of emissions, and it's true that emissions are improving. But it's also true that emissions are many times higher still than the targets that international oil companies have set for themselves in overall emissions. And what's worse is that we see a population of smaller producing wells emitting more that makes the average of the industry even higher. But decommissioning is what I want to talk to you about today, like the picture you see on the screen. This is um, off the coast of Louisiana, where there are 500 such facilities, not all falling down, but 500 such facilities that are completely done producing, have been idle, and are still standing there. Another picture I have shows a wellhead bending and leaning over. Another one shows it spewing. Another one shows an oil slick down the coast from its leaking. It's a problem that we're going to have to solve. This graph shows how big that problem is. What I've done here is to examine databases of the entire onshore U.S. well population and divided it into three categories that are useful and easy to think about. There are something like one or 1.2 million wells that were drilled and plugged before modern times, and we're not sure exactly how many there are. But there are another nearly 2 million wells that have been plugged because we know of it. In the last, since the 1950s or 1970s, when good record keeping started, and about the time modern plugging practices began, we have plugged about 2 million wells. Together, those represent a large liability that could break loose and create problems in the future, something we have to come back and fix. But the primary issue we're dealing with is 1.9 million unplugged wells onshore U.S. right now. The, the surprising issue is how it disconnects from production. So as it stands right now, there are half of the wells in the country that are service wells not producing anything, idle wells, or orphan wells. 50% of the plugging liability is not contributing anything to profits or national energy security or anything else. Among the wells that are producing, 80% are stripper wells. But if you look at it differently, look at the micro producers and down, we see that 75% of the unplugged wells in the country right now are contributing 0.6% of energy production, primary energy production from hydrocarbons. The complement is that the other part of this is that the record high grand total epic production of oil and gas in the U.S. is coming from just 8% of wells. Now, Meanwhile, we're plugging pretty slowly. The industry together, well, the industry itself is plugging about 20,000 wells a year, which means that it would take us about 90 years if we were to continue this same pace all the way through, and we're never to drill another well, but just continue plugging at the same pace. It would take 90 years. Of course, it won't happen that way. We're going to keep drilling, and we probably won't be producing significant volumes of oil 90 years from now. But what's worse is that plugging pace is concentrated in areas where wells have to be plugged for the purpose of drilling new horizontal wells, Permian, Denver, Julesburg, notably. In other places, like northern Appalachia, the current pace for plugging of old conventional wells would take 300 years at the current pace. It's just not happening. It is happening. It's not happening at a pace that's going to get us there. Now, that wouldn't be such a problem if the companies that owned this production also owned this liability. But the problem lies in that companies have specialized. These low producing wells are owned by companies that specialize in depleting in operations. The high production is owned by companies that specialize in drilling. And those practices have been separated systematically over the last at least 10 years, maybe 20. So the, the high production is not in the same portfolio as the high liabilities. We're going to have to find a way to solve this problem because decommissioning is just an intrinsic part of the business. Right? This is something we understand. It's always been there. It's required by law, ethics, often by contract. And you can see from the map, these wells are all over. And they're all over the places that we live, too. But if a failure to plan is a plan to fail, and that's just not going to work. You know, you think the public is mad at us or has been mad at us in the past. Imagine if we leave hundreds of billions of dollars of liability. And the best estimate right now is that the decommissioning cost onshore U.S. is at a hard minimum 300 billion dollars, and most likely that today's estimate of cost would put it between 500 and a billion, 500 and a trillion. Um, so it's a hard problem, and the only thing to do is to eat that frog. For those of you who don't know the reference, it's a business book on getting things done and doing hard things, avoiding procrastination specifically. We're going to have to build this in, decommissioning in, to part of our standard practice. Now, most of us haven't been making good, strong plans for decommissioning. Mostly the plans have been vague and notional. We're going to have to start with understanding the cash flow that's available and understanding the liability that we're obligated to clean up. And at some point, we're going to actually have to plan and execute this work in the field. And that doesn't happen right away. There's going to be a gap. But in the meantime, this has to become a regular part of our business operation. We're going to have to regularly go through this cycle of understanding and planning in the same way we do other sorts of capital planning projects, long-term capital planning projects. If we just got to integrate decommissioning into the same thing. The first step is to understand your future cash flow, and that's pretty straightforward because most every company has and maintains a reserve report. Now, this is a schematic taken from the PRMS guidelines that shows notionally how cash moves in and out of a project. With the investment here at the beginning, asset obligations at the end. But what you'll observe here is that the cash flow in this time period, marked in red, of cash coming in, is the same amount of money as the cash flow going out at the end of life to pay for decommissioning liabilities. So at this point in life, this little point right here, smiley face, the uh, the project's producing $600,000 of free cash flow a month, and it's got 13 years of remaining life, and the net present value is $25 million, all by this schematic from the standards. But the undiscounted total future cash flow is zero. I know I've beat on this for a couple of years in my concept of holdback. The idea is really simple. On a cash flow basis, when you get to this point in life, this period of life, and it can be many years towards the end of life, the reserves are economically producible, but on balance, the project is a liability. By the terms of the PRMS as defined, the project is no longer economic and it's no longer commercial. In a cash flow basis, it's a liability. And all that, without hoping not to beat a dead horse, the point is we have to plan far in advance. Second thing we've got to do is understand how big that liability is. We'll start with assessing the cash flow and then look at the liability. And when we've looked at this in the past, we put them in our reserve reports in the past, mostly what we've done is to include single well plugging costs. And when we say plugging, we sometimes mean downhole operations, and sometimes we mean single well operations, but we don't usually mean the full scope of decommissioning. What we are obligated to do is, in fact, broader than just downhole plugging. Certainly, we have to do downhole plugging. Every jurisdiction that I know of requires also removal of what's at the surface and remediation of what's at the surface. And it requires removal and remediation not just on wells, but also on shared facilities, tank batteries, in some cases roads. So in New Mexico, the most recent orphan well program information shows that they're spending about $150,000 per well to plug, a little bit more than that. In the case of surface remediation, they're reporting that if everything goes according to plan and there's no problem, that they can spend $30,000 to $50,000 per site, per well site, to clean it up. But if there's a pollution issue, if there's remediation required, they can take into the millions. And they've reported that on average, blending together the problem and the non-problematic surface work, the average is working out to $230,000 per well just for the surface work. Now, that sample might be skewed towards wells with more pollution at the surface. The point is, it is, in any event, still significant. And then in some jurisdictions, we're required also to reclaim, to restore the surface. In New Mexico, in federal lands, in some large lease contracts required to restore it. For planning purposes, we have to incorporate something else, though. That's contingency. When we plan for drilling, we're going to prepare our AFE, a real cost estimate, a class 1 cost estimate, but we're still going to put in a contingency that's 10 or 15% of the total. Because sometimes you will go over. There's more uncertainty, more probability that you overspend than you underspend. The problem in decommissioning is that the upside tail of spending more than is very much longer. Instead of 10 or 15% overrun, you can have a 10x overrun or a 20x overrun. The worst I've heard of, and I've heard of two cases, was the planned cost was $20,000 and the actual cost was $2 million. That was a 100x overrun. So the average of a program of decommissioning is going to be significantly higher than the expected. That the mode, the even the well, the most likely scenario of cost is going to be relatively low. But and if you only do a few wells, you're going to see that most likely value. But if you do a whole program, you're going to have more of these instances of the high cost overruns, and your average will be significantly higher. So my rule of thumb, and it is just a rule of thumb because the data is still limited, is that this total scope of decommissioning is going to run on the order of 2 to 3 times as much as the downhole plugging alone. So if you've been used to thinking about $50,000 a well to plug the well, then you ought to be thinking about $150,000 per well, lock, stock, and barrel, tax, title, license, drive out. Then, of course, after you're done, you still have some liability. For anything that goes wrong, you're still on the hook. Now, this part that we know that we can quantify, those are called in the engineering literature, in the petroleum engineering literature, abandonment, decommissioning, and restoration costs, or ADR costs. The accountants call them AROs, asset retirement obligations, but functionally they're the same thing. They have the same meaning. It's the grand total of what you're obligated to do to clean up. We still don't have good estimates of this. Then we need to understand also what's coming next. How's it going to inflate? How's it going to change over time? Right? We're doing capital planning, but we're not planning to do much of the work, certainly not all of it, in the next year. We're planning it for several years in the future, so we need to understand how those costs are going to change with time. As far as I can tell, it's highly unlikely that salvage is anything more than like it is now. Zero. There's practically no value. And there are some dynamics that could push costs down. We could see some improvements in operational efficiency. For example, we do a program of plugging so that we minimize the distance between the wells when we're skidding the rig. And then maybe there's some learning curve. Overall efficiencies in the process. But bear in mind that we've already plugged half of the wells uh, that need to be plugged in by modern standards. We've been doing it for 50 or 70 years, and the standards haven't changed since, and the practices haven't changed since at least the 70s. And the improvement in the 70s was a balanced plug as opposed to um, setting a bridge plug. Not a huge difference. And then, of course, there is the idea, the possibility of technical innovation. The problem's a couple. One, very few people are researching it. Two, we're already working with very cheap materials. Three, most of the research that has been done has been for the purpose of improving quality, not of reducing cost. So it's more likely to have, even if we do have different technologies, more likely to be a higher cost than a lower one. Then on the balance, we have some forces pushing it up. Not most importantly, mechanical deterioration, which is really hard to quantify. But we know it has to be there for probably for the first couple decades of a well's life. An incremental year doesn't represent any significant incremental decay that would change the cost of decommissioning. But at some point, you're going to start having more complications in the wells. It's not that the baseline, most likely planned cost changes, it's that the number of wells with complications increases. You have more wells that are going to be on that high end tail, and over time, the average will get dragged higher and higher. Now, it's not 0%, but it probably is a 0% increase of cost over time for the first 10, maybe 20 years of a well's life. But the average age of an unplugged well in the US is about 40 years. The average unplugged well was drilled just before the price crash in 1986. So each incremental year, we probably have an increase of costs on the order of 1, 2, or 3%. Second, we have overall generic inflation. Inflation in the oil industry tends to um, go in spurts. Sometimes it's relatively flat. Sometimes it'll contract a little bit or temporarily. Sometimes it'll expand. But there is overall in aggregate uh, a trend upwards, just like in the rest of the economy, and closely related. But more specifically, there's a likelihood of increased cost by demand growth. Historically, the cost or the demand for decommissioning services was de minimis. It was as low as it could possibly be, and companies uh, did the work when sort of as an aside, a filler. Didn't do it with dedication. But in the last couple of years, as demand has grown, we've seen significant cost appreciation, and people in the industry have analyzed to show that the costs have to be significantly higher if we're going to build the equipment necessary to do the work. It's just like the shale revolution. You know, when everybody all of a sudden wanted 1,500 horsepower rigs to drill horizontal wells, well, then the cost of the 1,500 horsepower rig went up by 2 or 3x. And we risk the same dynamic here. And then, of course, there are pushes and with good need, I think, to improve the standards with which we plug wells. We haven't been studying how effective our plugging techniques are. Cement's a good material, but it does crack and it'll separate from steel, and we don't always pull the steel out. Uh, there's much more likelihood of improved standards for higher quality work than there are of diminished standards and lower quality work. And that will push the cost up. When you're planning, first thing is the scope of work that you need to bear in mind, and the second you're going to have to bear in mind is the priority of the work. And the top issue in the priority of work is always going to be what's needed, what's required under law. What's required by the regulations, by the state law, by the mineral leases. But then you also have to look at the risk of failure and the risk of consequences. Every state uh, with an that I know of has an orphan well program, and every state that I know of has a priority system for their orphan well plugging program. But companies are going to have to do the same thing. You're going to have to decide what's important, what do you do first, and then at some point you're going to go through and actually execute. Ha, I skipped ahead. But first, you're going to plan the work you're going to do. And there are a couple ways to do this to try to get efficiency. You can try to plan and optimize by hand in the same way we have planned and optimized drilling programs. But there are also several tools available to help use optimization algorithms and even in some cases AI optimization to create bundles of wells with the best combination of cost savings and um, effectiveness, prioritization. Well, and in those tools, the user, the oil company, can specify what they're optimizing for, what is of most importance to them. And then the optimizing engines can help create that schedule to minimize the cost while meeting the objectives. Really useful. And that can be done both short term and long term. But in the meantime, we're going to continue our operations. We're not going to go plug half the wells in the country next year. In the meantime, we're going to have to monitor, measure, and mitigate. We can't just leave a well standing idle indefinitely. We're going to have to keep track of what's happening with it to see if the prioritization changes, and if something breaks a leak, we're going to have to do something different. But then we're going to do the other kinds of processes that we do in normal planning. We're going to try to improve cash flow, and we're going to have to save so that we have the money when the time comes. But this is our stock and trade, right? This is what we've been doing. There are still some difficulties. There's new opportunities. There's also some difficulties. The first and most obvious is to produce more oil and gas. The Of course, if you don't save, it doesn't matter how much more you produce, right? If you are fantastically successful in producing more oil and gas, but you don't set aside any money for decommissioning, it won't matter. You'll still, it won't matter to the ultimate outcome to the public. You'll still orphan the wells. But we see a couple of dynamics systematically across the population of legacy wells. And one is that people have been trying to optimize these for a long time. I saw a project a couple of years ago now that was on its third company. They were trying to sell it, but it was the third company who had tried to acquire and exploit, the third company that had tried to find something new that had been bypassed and resell it. The strategy of acquire and exploit made good sense at an earlier point in the life cycle of the overall population. But we're not finding new fields anymore, new conventional fields. The kind of stuff that's susceptible to acquiring and exploiting, well, and the kind of stuff that's near the end of its life has already been through a bunch of that. There might be some more possibilities with shale. Maybe we can drill some more. Maybe we can do some sort of EOR. But on the large majority of wells, because we've only, of the 2 million unplugged wells, only something like 250,000 are even shale wells. The second issue to bear in mind is that wells, once they become irregular, they start producing irregularly. They, when they're reactivated, they're less likely to be reactivated and produce less. This graphic, it comes from analysis of Texas reactivations made by Environmental Defense Fund, and it doesn't have all the data on it. It's not as clear, but in the presentation, he explained what it does show first is that the longer a well stands idle, the less likely it is to be reactivated. Seems obvious enough. The overall probability of reactivation is relatively small, but it diminishes with time. Also, the longer a well stands idle, statistically speaking, the less it will recover as a proportion of original recovery when it is reactivated. So there are instances, there are cases. I've got a former client who reactivated a well in West Texas, and he's producing 50 barrels a day off a previously inactive well, and he's making bucks up. That does happen. It's just not systematically a great large opportunity. Now, there are opportunities for repurposing wells, and that could be a new source of income, and that would be a great thing. And there are a lot of people trying this, a lot of new technologies that might work. A lot of them will work somewhere. None of them are going to work everywhere. We could repurpose the wells for gravity energy storage, or maybe thermal energy storage, or possibly we could use them for carbon sequestration, although supercritical CO2 does not play well with abandoned or old, idle, decrepit wells. Maybe we could use the old wellbores to produce fossil brines for lithium. But all of these things have problems. They all have limited application, and they're all in early stages. I don't know of any one of these technologies that's past the pilot stage. The closest one is probably the best one, which is, in my opinion, it's the gravity energy storage. They're looking for a commercial application. They're looking to scale. But even that's not going to work everywhere. As people have been trying to struggle with this issue of how to pay for wells, well, decommissioning, there's also been a lot of play, a lot of talk, a lot of enthusiasm about plugging wells for carbon credits. For those of you who don't know, the concept is pretty simple. Um, a company that makes pollution doesn't want to make pollution, but they also don't want to change their behavior. So they pay somebody else to change somebody else's pollution so that in aggregate, the world is better. They make their own emissions, but they offset those emissions and create a net zero emissions. And there is some of this going on in the regulatory world where it's required. The majority and all of it for plugging for wells is voluntary. And then there are a bunch of companies that are trying to go down this road, and for different kinds of wells, orphan wells, idle, and there are R and B carbon wells that have been used. These companies is also some of their own projects, but they're doing it over a wider range of the kinds of wells. The limitation here is market acceptance first. Second will be the relative cost of emissions offset, relative value of emissions offset versus the cost of decommissioning. But last year, all of the major outfits took to market packages, the first, in some cases, the second packages of offset credits to try to be sold. And they're not selling well. The brokers will tell you that the buyers need time to become comfortable with them. They're not comfortable with them yet. And in fact, 3 of these are in the process of revising their protocol, which shouldn't be taken as a failure, because everybody on this slide was trying to create something that never existed before. But they are retrenching. I'm guessing that 2 years from now, this will either be dead or it'll be growing. We won't wonder about its future much anymore. And my guess is that it's not going to grow very far. It has best application to orphan wells, and not on the slide because not doing it for money is the Well Done Foundation, which takes donations and uses that to plug wells. And I believe that's going to be much more acceptable to the carbon markets than these kind of companies that are trying to profit from plugging wells that the oil industry didn't take responsibility for. I'm guessing, but I do think the model can be effective for high emitting wells in the short term. But it's not a solution that's going to solve the whole problem for us. Of course, the strong solution is the one we don't like. The best solution is to save the money. The cost of decommissioning is, by comparison to the cost of drilling, pretty small. Well, by comparison to the late life cash flow, it's pretty large. So the easiest, least painful time to save money for decommissioning is when you drill a well. And the second easiest, least painful time to save money for decommissioning is right now, because it's only going to get harder as wells deplete. Maybe we'll have another price cycle, but in the last super cycle, oil prices went from, call it $20 a barrel to, call it $100 a barrel. If oil prices are probably not going to quintuple again, but all the time volumes declined. So now is the best time. There is a tool to help you do this. It's called One Nexus, and this is functionally life insurance for a well. The operator pays a lump sum to purchase a policy. When it comes time for plugging, One Nexus brings a face value of a death benefit, if you will, back to whoever owns the well at that point. So it becomes an asset. that gets transferred with the well. And it provides some assurance that relies on the financial integrity of their backers, but that's Mina Gray, that there will be money available when decommissioning comes. And there's some disagreement, uh, notably between operators and non-operators, about whether or not the One Nexus product could be billed under the JOA. Um, it is specific to a well. It is directly related to operations on the well. It's just an expense occurred in advance to buy a product, a financial product, rather than to operate the well. The alternative, though, if you don't do something like this, is to get to the end of life and then hope that the non-operators will be willing to bring back and help reimburse 10 or 5 or 10 or 15 years worth of historical cash flow, put it back in to plug the well. And in our normal business cycle, figuring things out and going forward year by year, we're going to have to learn how to improve our cost and our quality. There are a couple of resources that available right now that can help to design the most effective uh, completion of decommissioning. And those are good references to minimize the legacy liability. But there are two other studies that are available or soon to be available. One is National Academies of Science. It's a consensus study, not new research, but a consensus study that should be published in December of this year. And the Petroleum Technology Alliance of Canada has already done some research, and they're doing more research now. The only problem is, while the National Academies research is going to be free to the public, the Petroleum Technology Alliance of Canada is very costly. You have to join the consortium to see the results. And for some big companies, that'll be available. But a lot of these things don't cost much and can significantly improve the value. All right, we're going to do our best, right? Companies that plan to walk away from their liabilities is just not an honest business model. I'm told um, that the market rate, the going rate to pay someone to take over your liability is $15,000 a well. If you want to lay off your liabilities, you can pay someone $15,000 a well. They will take on responsibility for it, and uh, the obvious implication is that they just intend to file bankruptcy. That's not an honest business model. And the rest of us who intend to stay in the business, the rest of the companies who, I should say, who intend to stay in the business are going to suffer the consequences of these kinds of bad actors. And we can't, we're going to have to live with the consequences of that. If we want not to live with the consequences of it, we're going to have to make this unacceptable. In a lot of situations, though, there already is a problem because a lot of wells are already past that point of holdback. If there's not enough money in the cash flows, despite our best efforts, to plug the wells when the time comes, then what happens? There are only three options. The first option is industry pays, and that's always been the standard, right? The current owner is what regulations say and what makes most sense. In a few jurisdictions, there exists predecessor liability in which previous owners are on the hook. Louisiana, federal lands, federal offshore, and those programs have been successful, except that companies resist and litigate. But assuming they could be implemented, it's been effective. And the states that have the orphan programs have mostly used funds that come from other oil companies. In Texas, the orphan well plugging program has historically, for decades, been funded by the cost of a new drill permit. So it's the industry paying for the industry's messes, setting aside the issue of opportunity cost and what else could have been done with that money. That money is no longer enough. Historically, about 5% of the wells that have been plugged in the US have been orphan wells. Right now, by most recent count, 7.4% of all of the wells that are unplugged are orphan wells. Despite having decades of these programs, the current population of orphan wells is larger than the population of wells that have been plugged under the programs for all of history, and is growing because wells are depleting. And in the case of Texas, just this spring, the Railroad Commission got $100 million from the general fund to plug emergency wells in the state. And that's an example of the second option. The public pays the money, right? Yeah. And this is where the money exists. The IIJA and the most recent $100 million to the Road Commission came from taxpayers. Now, and taxpayers do have the possibility of having enough money. Charities like the carbon offsets is a possibility, but almost certainly not enough. Texas has a program whereby landowners can pay to plug the decommissioning of wells on their property and get partially reimbursed, but landowners aren't going to systematically have enough money or will to plug the wells. So either the industry figures out a way to pay for it on its own, or the public will pay the the cost of plugging the wells, or the public's going to pay the cost of not plugging the wells. The public will pay the cost of living with wells that are unplugged and deteriorating and increasingly leaking. So it's a hard problem. In May of this year, looked I published a report called Filling the Hole that looked at Northern Appalachia, both the status of the industry and what it would take to plug. And this is a good example of the best solution that I've come up with. This graph shows the three states in Northern Appalachia and the relative production from the new generation of shale wells compared to the prior generation of legacy wells. And the vast majority of the production comes from relatively young, high producing wells. But the legacy wells are the much larger portion of the liability. And like I said, the problem in Northern Appalachia, like everywhere else, is that there's one set of companies, think EQT and Range, that are drilling wells and own the high producers, and a different set of companies like Diversified that own the low producers. So as it naturally stands, the money is not in the profits are not in the same portfolios as the liabilities. But if we can move the funds from one place in the industry to another portion of the industry, then the industry can pay for its own decommissioning. In the case of Appalachia, depending on what you assume about how much will need to be covered and what the costs are, it's on the order of 5 cents to 21 cents per MCF of future production based on EIA reserve estimates that needs to be set aside in order to cover the legacy liability. Now that's something, that's not nothing, but it's not enough to change the investment decision, the drill no drill decision. And moreover, it is a small number by comparison to um, the EIA's estimate, not EIA, yes, EIA's estimate that LNG exports will increase the cost of natural gas to consumers by $1. This is much smaller impact. Now, this model of keeping the cost within the industry and off of the public comports with all the history, every kind of history, every sort of principle. It's not ideal. A perfect would have been a change 30 years ago, but it does meet the second best. The problem, though, is that not all states are like Northern Appalachia with shale production together with old legacy production. This map is a very coarse estimate of how much it would cost per unit of production to pay for decommissioning of the legacy wells in each state. Texas, New Mexico, to a lesser extent Oklahoma, have newer, younger production that's capable of paying for decommissioning. But a lot of other states don't have shale production that could cross-subsidize the plugging liability. California, Michigan, Alabama, Mississippi, um, well, Arizona and Florida too, but those aren't very significant. I think there are 300 wells in Florida onshore. That's actually the most restrictive. Florida is the most restrictive state in the country for drilling. Not Colorado, not California. Hands down, Florida is the most restrictive. But I digress. If we were going to try to use shale production to fund legacy decommissioning, it could work on a state by state basis for a bunch of states, but not for a bunch of others. If we did it at a national scale, the cost would be on the order of $2 to $3 per barrel, which is not nothing, but also not enough to change very many drilling decisions. Now, but then, of course, the question gets really thorny. The first question is painful. Second question is thorny. Who gets the money? Right? I don't think industry wants to uh, let the government have it, and the government doesn't want to give all that revenue to the oil companies. But I think the best solution is going to be something in the line of the Resolution Trust Corporation that resolved the savings and loan bankruptcy crisis created by the Reagan administration. A government sponsored entity that's subject to all the regulations of the government in the same way that an oil company is, but operates independently. They can take on all the liability for plugging the wells. They can take on the liability for future breaches of plugged wells and can systematically optimize decommissioning across the board. It is an ugly problem. But the oil industry, especially in North America, is very mature. We started early, and we're going to be one of the first countries to end. The shale has completely revived the industry, but there's no other prospect for any revival after shale. And the end of drilling shale is within planning horizon. Now, it'll take a while to decline. It will slow down, but it will end. And how the public remembers the oil industry, how our children and grandchildren remember us by reflection of how they remember the oil industry, is going to depend on how we finish. My dad used to tell me, finish strong. And that's what we've got to do. We have got to finish strong. Thank you. And let's talk. What am I missing? What do you think? How can we solve this problem?